In this video, I'm going to share with you 5 lessons that I either learned over the past year or they were lessons that were reinforced for me over the past 12 months. These lessons will help you be a more profitable stock and option trader. The first lesson I learned is that just because a stock or ETF is overvalued based on its historic performance, it doesn't mean it's going to crash in price anytime soon. Let me show you what I mean. Here you see the very popular ETF SPY. It's basically a piece of the 500 largest companies here in the US. And I've put some valuations here on the chart just for your reference. Notice if we go back about a year and a half to May 11th, the stock market was at what I consider a fair value. See, over the past 20 years, the S&P 500 or SPY specifically has traded at about a 19 PDE. And on May 11th, that's about where it found itself at. It was at that 19 PDE that it typically trades over the past 20 years. Now, over that 20 years, sometimes it's traded higher than a 19 PDE, and sometimes it's traded lower than 19 PDE, but on average, a 19 PDE is about fair value. You're not getting a great deal, but you're not getting a bad deal. You're getting an okay deal. Well, notice what happened over the next several months. Over the next 2.5 months, the S&P 500 climbed about 11%. As you see in my note here for you, at that point, it was trading for about a 21.4 PDE. So the question was, is a crash coming? Well, a lot of traders thought they were, especially fundamental traders. You see, fundamental analysis said that the market was overvalued. And indeed, the market did decline about 10%. Not some overwhelming crash, but the market was overvalued, so we expected a retracement. And that's what we got. But then a little over a year ago, the market did something pretty wild in my opinion. It took off. It went up a lot, really fast. In fact, as you see here, over the next 8.5 months, the S&P 500 went up almost 36%. I mean, that is a huge climb in price. Notice my notes for you up here. At that point on July 12th, which is about 6 months ago, notice what the PDE was of SPY of the S&P 500. At that point, it was almost 25. It came in at about 24.75 blended PDE. Overvalued? Well, I believed it was, but the market had experienced a sharp increase in price. So overall, the market was saying that it was not overvalued. Obviously, the market thought it was fairly valued. But based on its historic record of being priced at a 19 PDE, well, in my mind, it was really overvalued. So I was expecting a crash. Did it crash? So-so. Notice that we experienced another 10% decline. And then notice what's happened over the past 5 to 6 months. We experienced another increase in price. In fact, the price was up about 17%. And here in the past few weeks, we experienced another decline of around 4 to 5%. So today is December 20th of 2024. And right now, our blended PDE, based on where SPY closed on Friday, which it closed at $592.12, our blended PDE is about a 24.77. So it's overvalued by quite a bit based on its long-term average PDE of 19. So is a crash coming? Well, you might expect there would be. And in fact, I do expect the market to go down at some point in the future. But is it today? Well, it's not today because today's Sunday, but is it this coming week or is it the week after? Well, that's what we don't know. We can use technical analysis to tell us once the market has shifted from a bullish market to a bearish market, but as of right now, we're still in a bull market on many time frames. So the lesson here is very important. It's very important to me and it's very important to you. Just because an asset is overpriced based on its long-term average, it does not mean that it will stop going up in price. We see a nice example of this over the past year. So when you're trading stocks or options, just keep in mind that just because an asset is overpriced, it does not mean it's going to go down in value the next week. It could take some time. But as you see here in the long run, stocks and ETFs, they do tend to return to their average, which in this case for SPY is a 19 PDE. Now there's a lot of growth figured into the S&P 500. If that growth doesn't come to fruition, well, at that point, we may experience a very sharp decline. The number one lesson here is keep in mind that the market, it can stay irrational longer than you can stay solvent if you put yourself in a position where you expect a decline, you're positioned for a decline, but the market doesn't decline. Just make sure you can deal with the market continuing to go up even when it is apparently overvalued based on its long-term average. Now, speaking of valuation, we'll move on to my lesson number 2 that was reinforced for me over the past 12 months. And that lesson is that it's hard to go wrong when you're trading in undervalued companies. Don't get me wrong, you can make a lot of money trading in overvalued companies or companies whose PDE is a lot higher than what we think it should be. When the market turns those positions, if the growth that the market's expecting doesn't happen in those stocks or ETF, well, it can be extremely painful. On the other hand, if you're trading in undervalued, stable, mature, consistently profitable companies, it's hard to go wrong trading neutral to bullish trades in those type of companies. And that's why every weekend I review the over 250 stocks that I watch and track to find which ones I believe are potentially undervalued. And I share that with my patrons. So if you'd like to see it, well, check out my Patreon group. So just make sure that if you trade in companies that have a very high PDE, make sure you're protecting yourself against those massive declines if the growth that the market's expecting doesn't happen. And that's one of the nice things about using options to trade in companies. You can position yourself to benefit from stock price appreciation or stock price declines and protect how much you have at risk. Now, speaking of stocks being overpriced or volatility or stocks going way up or way down really fast, that brings me to my third lesson that was reinforced for me this year. That is to expect the unexpected. Expect weird things to happen. Let me show you an example of that happened this year. Here you see a chart of volatility. It's VIX. Notice what happened back here in August. Now let me zoom out here so you can see what happened before that. The market was going along like normal. Had some ups, had some downs of volatility, nothing too drastic. But then all of a sudden, in early August, the unexpected happened. How unexpected? Let me show you. So we found ourselves here on the first day of August. That was a Thursday, August 1st. Well, volatility spiked up a little bit. Not much, 16%, we can deal with that. Notice what happened the next day. Spiked up a little bit higher. Now we're up 50% over just 2 days. Now move on to Monday and notice what happened to volatility. It was up over 300% in just 3 trading days. Expected? Absolutely unexpected. That's why I say expect the unexpected. The thing was, nothing was really happening except that volatility was going crazy. Then notice what happened the week and a half after that. It came right back down, right to where it started. So within 2 weeks, volatility was right back where it was before that huge 300% volatility struck. This is why I say expect the unexpected. Some wild and crazy things happen in the markets. So position yourself to deal with the unexpected. Have a plan in place so when things don't work out the way you expected, well, you'll still be able to keep playing this game with us. That plan for when things don't work out is vital for you to have if you're going to be a successful long-term stock or option trader. You see, you're guaranteed that things will not work out your way 100% of the time. I don't bet, I don't gamble, but I would place a large wager on the fact that things will not work out 100% of the time for you or for me. That's just reality. It doesn't happen. So what will you do when you place a trade, you go into a position, and things don't work out? Well, have a plan. And when's the best time to come up with that plan? Well, it's when you place that trade or before you place that trade. You see, when you're in the middle of the trade and it's going against you, it's hard to think clearly. So before you place a stock or option trade, know what you're going to do if the trade or position goes against you. Because in the heat of battle, decisions can be fogged or clouded by the emotions that take place as a result of our trading enemies, fear and greed. And here are 2 examples of that. These are 2 positions I've been trading in for many months. TXN I've been in for over a year, and both of them went against me. They started out as cash secure put options. When they didn't work out, we tried to roll them down and adjust them, but eventually I allowed them to be assigned to me. I then started trading the wheel strategy on them. We wheeled these 2 positions. We sold covered calls. We sold some additional cash secure put options. We worked the position based on our plan. And in the end, 2 days ago, we exited both these positions for a nice profit. And they both went in an unexpected way. If you train the wheel strategy and things don't work out the way you expected, you can always allow the stock to be assigned to you and then turn it into covered calls. If it's a dividend stock, you collect the dividends and you keep collecting covered calls until you can exit it for an overall profit. But there's other ways to plan for the unexpected. And here's a position where I could not let it be assigned to me. It's in RUT. So how did I plan for the unexpected? Well, notice here I told my patrons that my exit for this position, if things didn't go according to plan, if something unexpected happened, was to have an exit loss trigger. And for me, that exit loss trigger was that if the position was down the amount of credit I received up front, then I would exit for a loss. So that's the second way to plan for the unexpected if you're not trading the wheel strategy, is to have an exit loss trigger with a dollar amount or a percentage amount that you get out of the position no matter what's happening if your position reaches that loss. Another exit loss trigger might be a stop loss based on technical analysis. Here's what that might look like. We'll go back to our S&P 500 ticker symbol SPY. You might say, I feel bullish about SPY. What would be a possible technical trigger to exit a bullish position in SPY? I won't go into great detail about technical analysis, but I'll share with you one example of that. So I've placed this white line right at some previous areas of support, as you see here, and resistance, as you see here. It's a pretty decent level that you would expect it to hold as support. Well, notice what happened on Friday. SPY pierced that area. Now, I did close above that by the end of the day, but overall, this looks a little bit questionable. If SPY cannot hold this level and it declines, say, down here into the 572 area, well, my bullish thesis would be wrong. At that point, I might say, you know what? I'll exit a bullish position for a loss because what I expected to happen, the market to come down, test support, and then bounce back up, well, it's not happening. That's how you can set a technical exit on a position. But overall, this fourth point here is to make sure you plan for the unexpected and create that plan before you enter the trade. That way, when they go against you, your emotions of fear and greed, they won't influence your decision. You'll be able to make a decision based on logic and not emotions. My fifth lesson is if you're going to play shorter term trades, it's very important that you learn technical analysis. Only those who don't understand technical analysis or haven't learned it the proper way say, oh, that doesn't work. I've been trading stock and options for over 20 years. For the first about 50% of that time, I didn't do technical analysis. But I then spent a lot of time learning it, testing out my theories, and I realized more often than not, technical analysis tells me where the market is heading. Now, technical analysis doesn't get it right 100% of the time, but more often than not, it does tell you what direction the market is heading in. What you want to keep in mind is that just because the market is in a bullish trend, it doesn't mean it'll stay that way forever. So we can't say technical analysis is saying the market is bullish, and therefore I'm going bullish, and I'll be bullish forever. You have to be looking for signals that the technical analysis is telling you that it's switched from a bullish market to a neutral market or a bullish market to a bearish market. But when I zoom out here, we're in a bullish market. Now, although as I mentioned earlier, the market to me is overvalued, reality is the market's not agreeing with me. The market thinks it's fairly valued. And therefore, I'm trading the market like we're in a bullish market because technicals are telling me we're in a bullish market. But at the same time, I'm continually looking for signals in the technicals that were switching from a bullish market to a neutral or a bearish market. So if you don't know technical analysis, spend some time learning it. I have a whole video series right here on YouTube that tells you how to use technical analysis. I try and make it as simple as possible. I don't like complex, I like simplicity. So I think it'll be worth you checking out. Another thing to keep in mind about technical analysis is that you want to look at technical analysis based on the time frame charts that you're trading. For example, if you're a very long-term trader, well, you might look at the weekly chart. If you're an extremely long-term trader, you might switch over to the monthly chart. If you're a shorter-term trader, maybe 2 to 6 months, you can look at the daily chart. If you like being in trades for less than a month, well, you might consider the hourly chart. As you can see, all these charts might tell something different. For example, here in this hourly chart, I don't see a bull market. I see a bearish market. That's what's happened recently in the hourly chart. If you're a day trader, you might look at the 1 or 2 minute chart. The reason that we've been in a bull market here, a bear market, a slight bull market, bear market, now we're back in a bull market. And that was just in 1 day's worth of trading. So keep in mind that when you're looking at technical analysis, you want to use the proper time frame for the length of time you like to stay in your positions. So those are 5 lessons that were either reinforced to me or I learned over the past year, and hopefully the ones that will help you in your next 12 months of trading. If you'd like to get an alert whenever I buy stock or sell options, or an alert every weekend that tells you the companies I believe are potentially undervalued, check out the benefits of becoming a patron down at the link in the description below. Trading in an overvalued market can be challenging. If you'd like to see 4 ways that I trade options against SPY, which is in my opinion overvalued right now, check out the video at the link above and description below entitled How to Trade SPY Using Options. Until next time, happy investing, and we'll see you again soon.